You see? So we are first and foremost going to start with a correction I made in the group concerning Euro USD markup that was sent by one of my students. All right. And as I told you before, the markup was good. Nothing was wrong with it. It was based on principle and it was okay. But I rejected it immediately. And I told him to delete it. All right. Why did I tell him to delete it? Not because the setup was wrong. The setup was right. But having a sell setup in a demand, in a level that is close to demand, will not succeed. It will struggle. So now let me explain to you. And each time you carry your chart, go to what? Daily time frame. This is daily time frame. I taught you yesterday in day 3 time frame analysis, and I mentioned daily time frame. Remember, I have to mute everybody right now. I have to mute everybody right now.
Pressing the video.
Yes. All right. So I told you yesterday that there's what is called time frame analysis, top-down analysis. All those things I mentioned to you, I just mentioned them to you. When you get to intermediate, you are going to see them in details, how we do them. But what I'm doing for you now is not for you to be able to trade now, but it's for you to know the overview, it's for you to understand the general overview of what trading is all about. And those things that are foundational that you should understand, you should also get it. That's what I'm doing for you now. Okay, now, remember we mentioned demand and supply. And how you have to approach it is to first and foremost come to daily time frame, which is a much higher time frame. If you come to daily time frame like this, you look at the chart. Where is the flow? It's down. Because if you see that here, you have a drop down, you have a rest. You have a drop down, you have a rest. You have a drop down, you have a rest. You have a drop down, you have a rest. You have a drop down. What are you expecting next? Rest. Can you see? Now, after each of the drop down, right? After each of the drop down, when the market want to rest, what will the market do? Market will pull back. Market will pull back here. So when market is pulling back here, it is as what? Support, 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 support. What are you expecting here next? Support. So, and what do I tell you happens at support? The market buys. And after the market finishes its pullback, what's going to happen next? Selling at resistance, 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 resistance. What are you expecting here? Resistance. Do you understand here? So now, this is daily time frame. You can see that skeletally, we have X-ray this market. Excuse me. But if you go back to 1 hour time frame, how you are seeing this chart here, you are not going to see it like that. Do you notice that it's very easy for us to pick the top, pick the bottom, pick the top, pick the bottom, pick the top, pick the bottom? Very easy for us. And on this same time frame, if after you are expecting this market to come here and come down, if this market now refuses and break this level before, this top before, it broke it up like this, it means that the downtrend is over. That is the first sign that the downtrend is over. But are you supposed to buy despite the fact that it has broken this level? All right, it has broken this level. Are you supposed to buy it because it has broken this level? No, you have to wait. Let the market come back to this area before you now buy. So this will now be your buy opportunity here. Do you understand? It's your buy opportunity here. That is how to trade. When you get to intermediate class, you now be learning what is called market structure. When you are learning market structure, learning external break of structure, internal break of structure. You understand this that I'm explaining to you. So now, if we are expecting either a market to move up, either to break this level here, or the market to pull back to this level here and come down, all we know is that the market must come up from this level. Therefore, we can say this is a temporary demand. Because if this market come up and break this level, what do we call this area? Somebody should unmute himself and tell me, what do we call this area? If this market break up, come up and break this level here, what do we call this area?
Demand zone.
Correct. This is a tentative demand zone. This is a potential, that's the language I love to use. This is a potential demand zone. So if this is a potential demand zone, any sell opportunity that come here, any sell opportunity that come, you remember this is daily time frame. Any sell opportunity that come here in 1 hour time frame, is it good to sell? Is it good to sell? Correct. No. You now see, let me go to 1 hour time. So that my student had a perfect setup, only that he forgot that this is a demand area in a higher time frame. So you see, I'm not going to clean anything so that you can see it perfectly. Can you see it now? So, so what he did was that he was looking at this as a corrective structure. He was looking at this as a corrective structure to break down. But I'm seeing a pullback happening in daily time frame. And based on that, what did I do? I decided to buy this market. He is selling. I said, no, you shouldn't be selling. And I bought. And I made a handful of profit there. Do you understand now? So you can now understand what I taught you about excess demand, excess supply. You can't have excess supply. Go to daily. That's where you understand it. You can't have excess supply here. You can't have too many people that want to sell here. In fact, those that are selling, those that have been selling from here, look at it, from here, from here, from here. At this level now, they are taking profit already. All right, at that level, they are taking profit already. What did I tell you about taking profit? I told you that when sellers are taking profit, the market will look like it's buying. All right, you'll be seeing some massive pullback. It is as a result of profit taking. Because before, there was excess supply over demand. But immediately those that are supplying are taking their profit and they are leaving the market. And the buyers remain. What happens to these buyers? You have excess of the buyers as against the sellers. Do you understand now? You now have excess of the buyers against the sellers. That is the effect that you see, that the market will just reverberate to the upside. Market will just be pulling back. You know, so the essence, how you know a credible mentor is that mentor that have credibility. That mentor that can say, this is how it is, and you see it like that. You know, those that are not new here, that have been following us for quite some time, they will attest to it. When we say this is the direction of the market, it is going that direction. All right. When we say this market is not ready to go, it's not ready to go, because there are some things we will see before we tell you. So that is what a mentor can provide. That is the service a mentor can provide his mentee. You should be able to provide a focused leadership. That was what I demonstrated this afternoon. And I said, it's not going down. And this is the reason why it's not going down. And I intentionally said it because you are undergoing a foundational training on key fundamental analysis, demand and supply, and some of those key concepts. That was why I reiterated it and I wrote that piece so that I can support your knowledge and understanding of demand and supply and support and resistance. Is that okay now? You can see that here I'm not drawing any trend line here, and yet I'm telling you what the market should do. All right, for people that are drawing trend line, they can be drawing it like this. But I told you, I don't teach anybody trend line again because it is what? It is not objective. It is subjective in nature. All right. So I believe we are good with this now. So let's go to today's class, today's lesson. Rather, I think we're on lesson 4. Where is the course outline? Course outline. Yes. Okay. So I want to ask first and foremost, okay, Mr. Ambrose, raise hand. Can you talk? Can we hear you?
Yeah, thank you, Mr. Nat.
All right,
Please,
sir.
can you go back to that chart? There's a question I want to ask.
Okay. We are there.
Good. You know, before the final arrow that is going up.
Yes. This one. Here. Here. Hello. Hello. Here. Hello.
Arrow
Can
that is
you,
going up.
can you hear me? Is it this place?
No,
The
no, no,
uptrend, the uptrend.
Move forward.
Okay, here.
No, move forward. Move forward.
Here.
No, where you had the last circle you did ahead that arrow.
Okay.
Yes. Now, you know, there's a drop down and move up again. Supposing
Yes.
at that point, you know, suppose the market try to do a retest again, maybe
Okay.
instead of going up, do a smaller retest and take you down, a kind of final breakthrough. Can we not anticipate something like that? Or we just, from analysis, we just assume that it will come down, then go up?
Okay. Thank you very much. That is why when you get to intermediate session,
Yes,
you are going to be introduced. That if you follow us to that to that level.
oh, by God's grace, I must follow you to the advance. Eh?
Okay, no problem. You are going to
Right,
learn.
okay.
You are going to learn what is called Fibonacci. All right. You are going to learn what is called Fibonacci. Fibonacci. After you have had this level, this one. After you have had this one, broken this level here to the upside. That signifies a push to the upside because you have broken the last high here. So you are no longer looking for sell. You are looking for a buy. So now Fibonacci theory will now give you the idea of how much Can you hear me now? Hello.
Hello.
So sorry, it was my network that was fluctuating. Oh,
Okay.
so you see that this level now, you see that it has broken. It has broken this level. That is a sign that we are no longer looking for sell. We are looking for buy. So now, how much of this arrow, how much of this coming back do you require for you to have a valid buy? That is where you want to know the extent of this pullback. That is where at intermediate class, you will now understand, you will now need to have the idea and the knowledge of Fibonacci theory. Fibonacci theory gives you different levels of expectation of this pullback. So when you pick it here, this is a fib retracement here. So if you pick it from the beginning here to the end here, you are going to get different levels. I will have to increase the thickness of the line so that you can get it. Settings, go to coordinate, no. Visibility, no. Style, yes. So I have to increase the thickness of this line. Let's increase the thickness of this line. All right. Okay. Another one I did. Okay. By the way, are you seeing these levels? Are you seeing this level with some lines?
Yes, yes,
Okay. So you see, let me bring it here. Can you see?
yes, sir.
So now after this, you can see that when this thing came back to this level, came back here, it means that this impulse that you find here, 50% of it has been retraced here. If you get to this level here, if you pull back to this level, 61.8% of it has been retraced of this impulse. If you come back to this level here, it means 71% has been retraced. If you come back to this level here, 79% has been retraced. But as a general guideline, there's what is called golden ratio. Golden ratio is 0.618. I pick a level between 0.5 and 0.618. That's the level. So what I do is that as soon as this pullback has reached 0.5 to 0.618, I'm getting ready to buy. But in that case, my stop loss will be here initially, because there is a rule that when you have an impulse like this, all right, correction must not come to where that impulse started from. This correction must not be longer than this impulse. It must not come there if this is an impulse. So if you put your stop loss here, it will never be hit. Do you understand now? But how much it will correct, Fibonacci will give you the idea. But now what I normally teach my students is not to follow this Fibonacci. I'm not saying it's not correct, it's correct. But how do you know that it's going to stop at 0.5? How do you know that it's going to stop at, it's not going to be 0.5, it's going to be 0.618? How do you know that it will be 0.71? So you don't know. But there are some key concepts that I will show you based on what is called candlestick pattern that will tell you there is a candlestick pattern. There's a relationship between candlestick pattern and market opening, market session. Okay, when you understand these two relationships, you will know whether it's going to stop at 0.618 or 0.5. For instance, you have engulfing. If you have the last move that hits 0.618 and market open, as soon as market open, the first candle, first 1 hour candle that form engulfing here at market open, you know that it will never come below this place. So all you do is just to buy it on the other side. You are now seeing this arrow. This arrow will not take effect. This one here will not take effect. This long one will not take effect. Do you understand now? So this is how you know. When you enter into it very well, you are going to see what is called engulfing candlestick. Engulfing candlestick is going to form where this correction is over. All right, engulfing candlestick will form. That is how you know it. All right. So
Yeah.
are you satisfied now?
Yeah, nah, you are the pro. You've explained it.
Okay,
I'm very clear now. Thank you.
all right, sir. All right, sir. All right, sir. So let's go to day 4 right away. Day 4. Day 4 is, we are just going to look at the meaning of some of these fundamentals. I've already introduced them to you when I was discussing type of analysis in the market. When we're looking at fundamental analysis, I was just supposed to mention them, but I broke them down into pieces for you guys. So this day 4 is just like a kind of continuation of what you learned in day 1 or so, that day 1 or day 2. Why am I repeating it? I'm repeating it because 95% of traders of financial markets don't understand this. And we know the statistic that we have. The statistic before us is that over 90% of traders fail. So can you now see that there is a relationship between 90 to 95% that do not understand this foundation that I'm teaching you? Do you see that there is correlation between that 90 to 95% of people who do not understand what I'm teaching you and 90 to 95% of people that fail? Meaning that 90 to 95% of people that fail are those that fail to understand this basic foundation that I'm teaching you. So the remaining 5% are those that study this basic foundation and understand it perfectly. See, when you study it and you understand it perfectly, you'll be able to have a commanding posture. So, and that is why, this is the reason why you are expecting so thing to behave like this, because you understand perfectly what you are doing. You get me now? So that is why I have to repeat it so that you understand it very well. So number one, tonight is just going to be 1 hour or so by the grace of God. Number one, key fundamentals to understand. There are some key fundamentals you must understand. All right. Number one, you must understand GDP. When you say GDP, because they will always release GDP report of different countries. And I will also show you where you will see all this data, where they release all this data, okay? GDP, when you say GDP is the total productivity, the total summation of productivity of a country. When I say total productivity, some people will say, somebody that is a dry cleaner, is he producing anything? Do you understand now? You say somebody that is a dry cleaner, is he producing anything? No, but it's rendering service. So including those that are producing in factory, those that are teaching, those that are in telecommunication, those that are in transportation, those that are iron benders, those that are civil servants, those that whatever you do that you earn income. When you earn income, you are already contributing to the gross domestic product of that economy. Do you understand? That is the simplest understanding, the simplest explanation I can give to GDP. All right? GDP is the total summation of all income of everybody in a particular country. All right? It is different from gross national product, but we don't need that. I've told you from the beginning that there are many things to know, but not everything is important. What do I say? There are many things, you know, the mistakes some of us made when we started, you can't make that mistake again. We have learned so many things that we are almost like learning too much. But is it everything that is required to trade? No. Is it everything that is required for success? No. Therefore, you are fortunate now to have access to somebody who can clearly identify what works and what does not work. So I'm telling you now that gross national product, you don't need it. When you are reading anything about gross, forget it, you don't need it. What you need is GDP, gross domestic product. So if gross domestic product of a country increase more than before, if it increases more than before, it's good for the economy. All right? But now, this is where I now want you to understand something. Do you know that they can release GDP of, let me use America as an example. They can release the GDP figure of America today, and it increases more than last year, and it is still negative for the economy. Somebody will say, why, how? I am telling you now, so that when you are reading economic report, you are doing, at the same time, you are doing what is called comparative analysis of that report. The question is that if the GDP last year of America was 30, for instance, 30 billion, okay? And then you are expecting that GDP should increase by 10%. That's our expectation. That is the forecast. Meaning that you are expecting that when they release it this year, 10% of 30 billion is 3 billion. Is that not? So you are expecting the GDP this year to be 33 billion. Okay? You can see the previous 30 billion, the expected 33 billion, and then when the actual is released, it now increases by 5%. 5% is 1.5 billion. So 1.5 billion plus 30 billion. Instead of 33 billion, it now give you 31.5 billion. So even though you now have increase in GDP, it is negative for the economy because they are not able to beat the expectation. So therefore, the value of their currency will drop. I don't know if somebody is getting something now. Many
Please,
of
sir,
you.
can you go back?
Okay.
Please,
Let
can
me
you just repeat that GDP aspect? Sorry.
Okay, I will go back now. Let me explain, because there are many people who are here with us who have been trading. But this secret I'm saying, I'm telling you this evening, they have not heard it before. Their one is that, the news is positive. We are buy USD JPY. All the people that call themselves group, they say they are experts. They say, oh yeah, USD JPY, buy. USD card, buy. 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 Why? They say that the GDP figure of US has increased from by 5%. So I said, if the GDP figure for last year was $30 billion, for instance, and the expectation is that it should increase by 10% this year. So that 10% increase, or 10% of 30 billion is 3 billion. So if it will increase by 10%, it means that we're expecting that the GDP this year is supposed to be 33 billion. So you can see the actual was, you can see the previous was 30 billion. The expected, we're expecting it to increase by 10%, which is 33 billion. Previous $30 billion, expected $33 billion. But when the figure is actually released, the actual figure is released. Instead of a growth of 10%, we had a growth of 5%. So growth of 5% is not 3 billion, it's 1.5 billion. So instead of the expected, instead of the actual to be 33 billion, okay, the expected to be 33 billion, the expected is 33 billion, the actual become 31.5 billion. You can see that the actual figure that is released is 1.5 billion less than the expected. So it is negative for United States. Even though the economy is improving, the economy is performing, the GDP figure has increased from 30 billion to 31.5 billion. It is still negative. The value of dollar will drop. Why will it drop? Because our expectation is that it should grow by 10% to measure up to 33 billion. But it failed to meet up with 10% expectation for growth, and the actual was 5%. So they were able to add 5% to the GDP and not 10%. So that is a minus to the economy, meaning that there were some things that they were supposed to put in place to actualize 10% growth, but they were not able to do it. So it's a minus. So in that case, we are going to sell off. We are going to sell off USD. Some people will now say, why is it that we had a positive news and yet USD is weakening, USD is falling? This is the reason. You know, somebody had to pay me some tokens. I told him, I will collect money from you, this guy. If you don't pay, I will tell you this thing, because it's information that not many people know. He thought I was joking. I said, you are my friend. In fact, it's somebody that I give a lot of work to do for me. But I said, for this one, I'll collect money from you. He paid me $100. I said, yes. This is the $100. If I'm spending it, I'll say yes for that information I dish out. That's why I collected this $100. So it's the same thing I have told you this evening. Do you understand now? So that is, and the same thing, the way you apply it to GDP, that is the same thing you apply to all other economic indicators. When they release it, you know, see, let me show you an example. I have to show you an example right away. Okay? Let me show you an example before we move on. Let's go to forexfactory.com. 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 If you are seeing forexfactory.com, just mute yourself and say yes.
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 Okay.
Yes.
So you go to calendar. Yesterday, I told you to go to news. Can you see news? The US dollar is overvalued compared to other currencies. Say, can you see? Treasury, currency trade. This is where you read the news. Zelensky says there is a high risk that peace talks with Russia will end. Can you see? So this means the war will continue. Can you see? So here you go to calendar. Calendar. All right. So when you come to calendar here, you go up. What do you see here? You see details. Sorry. You see detail, Abi? You see actual, Abi? You see forecast. Forecast is expected. What is expected? You see previous. All right? You see actual. So now let's go to BOC governor. No. Let's go to one key news right now. Let's go to look at trade balance. Let's go to this trade balance. Can you see that here under this trade balance, Japan JPY trade balance, preliminary industrial production month on month. Do you see that here is under here is the first one is actual. Actual is actual here JPY. No, let's go to unemployment rate. It's easier. It's closer to the top. See unemployment rate here. Here, I see my caution. You are seeing my caution, Abi?
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
See unemployment rate for Japanese. Look at it. Actual is 2.6. Forecast is 2.7. And then previous was 2.7. Meaning that previously unemployment rate was 2.7%. Can you now see that unemployment rate is very low in Japan? Do you know why unemployment rate is low in Japan? What did I tell you yesterday? I told you that they always want to protect their local economy. They can even go ahead and make interest rate to be 0. They can even make interest rate to be -1. Meaning that if you go and keep money in the bank in Japan, they will charge you for keeping money in the bank. They want your money to go and invest, to go and work. And let me tell you, when everybody is investing, will there not be employment? There will be employment opportunity. Yes, that is why you now see that unemployment rate in Japan is among the lowest in the world, because Japan don't care. Now they were supposed to increase interest rate yesterday. They said no. Let the value of their currency to fall, no problem. In as much as they are able to protect their local economy and they make employment available to people. They want to encourage exportation. They will be producing so much that they don't have where to keep it. That is Japan for you. Can you now see that all I've been telling you, you can relate it together now, and you can see another result here. So now, But what is the actual? 2.6. You can see that this 2.6 unemployment rate is better than 2.7. So this is a good news for Japan. And you see that it is written in green. If it's not good for them, it will be written in red. But let me now give you an instance. If you have 2.7 here, and they are expecting it to go to 2.8, no, let's say they project it to increase to 3%, which is bad for the economy. But on getting here, instead of 3%, it is what? 2.8. 2.8. Do you see that this 2.8, which is the actual unemployment rate, is greater than 2.7? It means that the economy unemployment rate is increasing, but it will be written in green. Why will it be written in green? Because it is better than 3%. That is the forecast. You are forecasting that the economy will be worse at 3% unemployment rate. They end up to be what? 2.8. Even though this 2.8 is worse than 2.7 before, which is still bad for the economy, but for that it is less than the forecast, it is good for the economy. I don't know if you get it now. It's as simple as that. This is how to analyze it.
Yes, sir.
Yeah. Do you have question? No. All right.
No, it is
So,
No, sir, no, sir.
Okay. So consumer price index. I will leave the mathematics of consumer price index. Why? These are part of the things that knowledge that you need, and knowledge that is there that people learn, but you don't need it. All you need is you know the meaning of consumer price index. All right. After you know the meaning of consumer price index, know how they release the figure. That's all. Don't need, leave all other details for the economics. You don't need it. You understand now? So now, when you say consumer price index, what do you mean? Consumer price index. In a simple term, CPI is the same thing as what? Inflation. CPI is inflation. When we get to the core of economics, we differentiate CPI from inflation. We use mathematics to do that. But for now, take CPI as equal to inflation. So some countries don't call it inflation, they call it consumer price index. You see, when we are analyzing the basket of the increase that we notice when you look at the basket of commodities, of essential commodities like sugar, like salt, like rice, like beans, like all these daily things that we consume, when you are looking at the increase in price month on month or year on year, you are looking at consumer price index. But when we are summing them up and we are analyzing them to get a whole number, we are already talking of inflation. I think you are seeing the difference between consumer price index and inflation now. When you are talking of basket of goods and commodity, we are talking of consumer price index. So if it is possible that consumer price index can increase and inflation is going down, what do I mean? If you are looking at the basic thing that we eat every day, price of sugar last month, divide minus price of sugar this month, minus price of sugar last month, divide the price of sugar last month, give you a figure. You understand? So when you now add all the basket of commodity like price of sugar plus price of salt plus price of Maggi plus price of beans plus price of this month minus as sum up all the prices of common goods and services last month, minus it, divide of that of last month, you get what you get the idea whether things are increasing in value or things in prices or things are reducing in prices. This is what your Nigeria this thing of statistics, Bureau of Statistics, is what they are doing. They send people outside to get these prices, and they return to office and collate it, and mathematically they solve it, they solve the solution, the problem, and give you the answer. At the end of the month, they say Nigeria Bureau of Statistics or National Bureau of Statistics has said this, has said that. This is what they are doing. Do you understand? So if they are releasing a CPI report of a country and it is higher than expected, it's not good for them. That's inflation. And if there is inflation, you already know you already know how a country can solve the problem of inflation. Do you understand? You already know. You know that they can use bond. They can use bond. They can sell bond to the people, you know, with high interest rate. So when they are buying bond, you know, when they are buying bond and they are attracting them with interest rate, they buy it. When they buy it, they will mop up money from circulation and inflation will come down. You understand? So let's go to interest rate. You already know what interest rate is all about. Interest rate is cost of borrowing. Cost of borrowing. And they use it to achieve many things in the economy. Interest rates must not be too high and it must not be too low. If interest rate is too high, if cost of borrowing is too high, it has a tendency of affecting investment. Okay, of affecting investment. And investment is a key component of the GDP of any country. When you talk of national income is equal to consumption plus C plus I plus V plus investment. Consumption plus investment, you know. So if investment is affected by higher interest rate, it is problem for the country. Do you understand? Higher interest rate is capable of killing businesses, but no one can borrow money. Do you understand? Then low interest rate is not too good for the country too. Because if interest rate is too low, it is good that you'll be able to borrow funds at a cheaper rate. It's good. Be able to borrow funds at a cheaper rate. But then, what do you think will happen when interest rate is too low? See what's happening to Japan? Their interest rate is too low. The value of their currency, what will happen to it? It will drop because that currency will not be attracted to any investor. No investor will demand for it. And I told you, when demand is absent, then there is excess supply. And when there is excess supply, the country's currency will fall. Do you understand now? That is interest rate. Understanding sentiment analysis. Risk on, risk off. Understand sentiment analysis. Risk on, risk off. What is sentiment analysis? All right. When you say sentiment analysis, you are talking about looking at the overall picture of the market and picking a sentiment on that market. And based on that sentiment, you can decide whether to invest or to hold your investment or to diversify your investment portfolio. What do I mean? For instance, let's look at two types of risk environment. Risk environment can either be risk on or risk off. I've explained the periphery of risk on and risk off yesterday or the day before yesterday, but I now want to explain it in detail. When you talk of risk on, what do you mean? For instance, when you know the there were times that there are no war, there are no political problem, everything seems to be all right. And you know that time the market will be trending, Forex chart will be trending, all those things. That is a risk on. When there are risk on, certain currencies will be trending well, will be buying. What are those currencies? Currencies like AUDs. AUDs, they will gain a lot of strength. The GBPs, the euros, they will gain a lot of strength. Why? There is financial stability and there is no risk that is expected in the economy. All those currencies will gain a lot of strength, and that's what is called risk on. Many investors will diversify their portfolio to currencies. That is a risk on environment. And some of the safe haven assets like CHF, like JPY, they will be falling. In situations like that, they will be falling. This is what is called risk on. Then what do you mean by risk off? When there is risk off, it's a period of instability in the financial system. A situation where a period where you have what we call recession. When economic problems degenerate to the level of recession, when there is political tension in a region, when there is tsunami, when there is war, when there is this, nobody is sure of the financial state of any economy, no matter how powerful a nation is. If that nation is involved in war, it will be affected. A research was conducted, by World Bank to let us know how much Ukraine economy has lost as a result of this war. And the report shows that Ukraine has lost 40% of its economy because of war. How long has this war taken? The war has barely taken more than 2 months, about 2 months or 3 months. And 40% of the economy of Ukraine is lost. Can you see? Excuse me. And as a result of the war, many economies have been affected. Now, direct supply of natural gas to Bulgaria has been halted. And Russia will stop supplying natural gas to many European countries. Simply have sanctioned him. He's also trying to retaliate. So what am I saying? All the industrial production will go down and it will affect the economy. Do you understand? So in such circumstance, no investor is sure and uncertain of the financial stability of any country. Financial stability of any country is not guaranteed in environment of war and political instability. That's why when Nigeria election is about to take place, many investors from capital market, they sell off their share and run away because they are not sure of what will happen aftermath of the election. The same thing is applicable in many parts of the world. When there is a situation of uncertainty, people don't invest in assets that are directly linked to that country, like their currency. So in risk of environment, they sell off their assets that is associated with those economies and invest it in safe haven assets. What are the safe haven assets? Like gold. No country is saying, no country can say it's directly associated with gold. No. Like silver, like Bitcoin, like commodities, metals in general, invest their money there. That's what is called risk off. And what happened to AUDs? AUDs, GBPs, euros, they will all come down. They will all fall in risk of environment. Do you understand now? Let's move to outline 3. Don't need to spend more than 1 hour today. Outline 3, understanding behavioral analysis. Now, let me take you to the chart. You have already understood the foundation of behavioral analysis the other time. But now let me take you to the chart. You see that here, this market drop down here. Let me go to 1 hour time frame. Behavioral analysis. I want to give you idea of behavioral analysis. Now, look at here. The market drop down. This is corrective structure. Okay, but you see here, remember what I told you. Maybe those that have been trading will understand this better, but just wait, it's not difficult. This consolidation here, you see the break to the top is to deceive you. All this break to the top is to take liquidity from what? From supply and drop. What did they tell you? They say this resistance. Sell here, sell here. Say it's a lie. Don't follow them. This consolidation will happen. This push up to the upside will happen. Pick liquidity from supply and go. Now, to understand behavioral analysis, what we want to find out is that when this market come to this level, let's pick horizontal line. I want you to tell me the time. What is the time? Look at it down and tell me.
9 o'clock.
Correct.
9 o'clock, sir.
Correct. What did I tell you? Which session do we have 9 o'clock?
London.
London section.
Correct. What did I tell you about London session?
Corrective
Okay.
section.
Reaction takes place.
Reaction
there.
and consolidation.
No, I say Asia session is consolidation. You see the
Yeah, London
consolidation?
session is reaction.
Yes, you see the consolidation here?
Yes, sir.
Yes.
Do you see this move to the upside?
Yes,
Yes.
sir.
Yes.
That is beginning of London session. That is a reaction. What is this?
Pullback.
This move that come
Downtrend.
down. That is the continuation.
Yes.
That is the main trend. That is the main trend. All right? That is the what? The main trend. So now you already see that this market now is a downtrend market. All right? You already know that this market is coming down. But look at what it's doing here. Some people who do not understand what I'm teaching you now, they will be buying this one. No. Why? Are we not going to buy it? Look at here. Look at this area. This is the consolidation of the Asian session. This is the reaction of the London session. Then I will show you the beginning of New York now. You see beginning of New York, I will show you. When is New York starting?
1 p.m.
1 p.m. Now let's put this thing in 1 p.m.
That is it.
Can you see? Now let me now ask you, when this guy starts going 1 p.m., did he look back?
No.
That is
No.
what I'm telling you, that when you are looking at the chart, if you listen attentively to everything I teach you, you now get to a level where you don't need to draw anything. You look at it. If setup presents itself to you, you will definitely make money. If it does not present itself to you and you don't see what we are talking about here, forget about it, don't trade. How many trades did we take all through this week? 1. And he gave us few pips and retreats. Some people got break even. Some people took small profit and we left. Are you okay now? If you do not see setup, it's not a must to trade. Some people, I asked a question in the group, nobody answered me. I said, have you found yourself in a situation where you see that it's just a must that you must trade? A trade must be running. You know, it's tantamount to failure. Why don't you allow your account to rest? If you are not set up, you leave it. So now, you now see that we're able to match the session with the behavior of this market. And we're able to pick our trade here to the downside. Are you seeing it now? That is how you analyze the market based on what is called behavioral analysis. What is the behavior of price in Asia? What is the behavior of price in London? What is the behavior of price in New York? And that is what you are going to use to determine your setup. So, that's the case. If you are looking for a buy and you see a market is just hold on. You see that the market is going like this. The market is going like this. Correction. Correction. And this correction now, you see, is what? Asia, Abi. Now, in London, if you now see boom here, you now expect that from here. What are you expecting? Boom. Because you will now see that this is the Asia correction, reaction time for London, boom, for New York. And you continue to see it like that. But what if you now behave like this? Asia, London, and it's uptrend. What will that tell you? Somebody will tell me what this means.
Yeah, it will sell off because it has peaked liquidity at supply.
Correct. It means you are following. So we are expecting that if this is supposed to be, this is an uptrend, if it must still continue to go up, it's supposed to come and pick liquidity at demand here. Just as this one comes to pick liquidity at demand and move up. But instead of coming to pick liquidity at demand, London session push it to supply, to pick liquidity at supply. That means that New York session is going to break it down. Correction, break it down. Simple. Do you understand it now? That's what is called behavioral analysis. You are looking at the behavior of the market, the reaction of the market to time frame analysis and to what? To market session. All right, that's behavioral analysis. When to trade, how to trade. I've already told you those ones. All right, your assignment. Explain the following concept and how they affect currency market. Interest rate, GDP, inflation rate. That's your assignment. Any question? Any question? Any question?
Okay, sir. So, from what you explained in the last markup.
What's your name first? What's your name first?
My name is Esiri. Esiri is my name.
Oh, my my friend. Esiri, welcome.
Yes, sir.
Yeah.
So, from the last markup you made,
Yes.
I saw that the truth trend started in the London session around 9 a.m. So that means the truth trend might not always wait till New York session before it starts, right?
Yes.
Okay.
Yes. But I encourage you to wait in New York. Why do I say you should wait in New York? Because look, let me show you something. See, when this happened, immediately this happened, boom, like this in London. I see that the last top here happened here. And as soon as it came and broke it, what you will look for me is that between here and here, where is the psychological level? So you can say that, yes, that's what you look at.
Okay.
A Siri, that remind me in our private session, I must teach you what is called price level. All right.
Okay, sir.
Price level in relation when we do liquidity, after we are done with liquidity graph, remind me to about price level so that we link liquidity graph with price level. Get
Okay,
a
sir.
better understanding. So look at it here. What is the price level here? You see
Is
that it is 1.0930.
yes.
If this thing has come to 1.0950, I will sell it immediately. I'm not waiting for anything. In fact, I can even place pending order here, 1.0951. Let it pick liquidity there and drop. But unfortunately, it did not get there. So since it did not get there, you now be waiting for it at psychological level. And I will show you something now. Watch. Where is the next psychological level here? Can you see? 1.0900. Boom. That's it here. That's it here.
All right, sir.
So now, what is the time here?
Is
That it picked this market at psychological level here. What is the time?
12 noon.
o'clock.
12 noon. Yeah.
12 noon, that preparatory for New York session.
Yeah.
So the actual trend starts from New York session. Can you see this candle? This candle here. I'll show you something now. I don't know if I've showed you before. Do you see that from here? Actually, the move has started here. But at the beginning of New York, what do you see? Market move up.
Yes.
After they move up, what do you see here? Move down.
Continuation.
So
Yeah.
now, look at this combination of these candles here. What do you see here? What combination of candles is this? Engulfing. Engulfing. That it gives you enough clue that, oh, guys, liquidity has come. We are going down. Does it come back to this level again? Does it come back to this level again? No. Does not come back here again. Sorry, guys. The network is a bit unstable. So you see it? That's what we are talking about now. You understand now?
Yes, sir.
All right. Any other question?
Sorry, we lost you at the engulfing candle. Can you please go back to that engulfing candle?
Yes. Immediately I noticed that you lost me. I just kept quiet. It's my network. Oh, I don't know. So I said, this is the beginning of New York session. You see that the beginning of New York session, you notice this candle form, this green candle form, just to deceive people. As soon as it form, the next candle, 2 o'clock. Now, let me now tell you something. It's part of behavioral analysis. Do you know that when we say New York session open by 1 o'clock, do you know that capital market will open 1 hour later? Do you notice that?
Yeah, that is a New York Stock Exchange.
Yes. So I've really studied this behavioral analysis so much. So now let me show you something. You see this green candle that open here? That is New York session open. But the true volume will come in when the New York Stock Exchange starts. And that's where you see this one come down. Can you see? This is just the bank opening cause this to go up. But as soon as they ring the bell, gang, 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 this one come down straight on. Go and research it. Go and look at your chart and check it. The first hour of New York Open will play prank with you. But I target my entry at I target my entry at capital market open. That's what I do. Capital market open. That's what I do. You understand? It's as simple as that. Any other question? Are you hearing me?
Yes.
Any other question? Okay. I assume that we don't have any other question.
So,
You say what?
hello.
Yeah.
Sir, please. In America time, what time does their bank open, sir? Or when do their sessions start in America itself?
Didn't you watch our session on market?
Oh, yeah, I know. Yes, I know. Is it 8 a.m. for them, or
So
is 7?
No, it's 8 a.m. 8 a.m. for them.
Okay, you know the time difference is really so I have to be careful too.
Okay, it's 8 a.m. for them.
Okay.
But for us, 8, 9, 10, 11, 12, 1, 2. Either 7 p.m., 7 a.m. or 8 a.m. I don't know.
Okay.
But for us here, it's 1 p.m. You know, I'm only concerned about the time for us. Whatever it is for them, I don't know. But for us, it's 1 p.m.
Okay.
Yes.
Yes.
Yeah. Another question. Okay, so have a lovely day, guys. Bye for now.